All right, good morning and welcome back here to Trader Minute. Great to have you aboard. Let's go out and talk about technical analysis. We'll talk about 30, 40 minutes here today, kind of build some of the premise, some of the basis here. And then over the next 4 trading days, we will start to dig deeper and deeper into what technical analysis is and how to use it, some of the tricks that are out there. But whenever we're dealing with technical analysis, we need to understand what we're dealing with, what the theories are, what the assumptions are, and what the limitations are in regards to technical analysis. Now, I'm fond of technical analysis. For me, it has been a great source of income over the course of my life, and it's something that I rely on going forward. Are there problems? Are there flaws? Are there issues with it? Absolutely. But there is some great value to be had there as long as we understand what it's really showing us and what the real context is. Okay. Now, in the markets, there are basically three types of analysis that are discussed about, and in a lot of academic communities, you hear these types of analysis brought up, and they'll talk about fundamental analysis, which is by far the most popular analysis out there. And this is taking a look at earnings, taking a look at what the management doing, margins, general business activity. Talking about different ratios like a PE ratio or a book value. Fundamental analysis gets into all the company metrics and not so much the price action of the stock, but what's going on internally within the company. By far and away the most popular type of analysis, and also a type of analysis that has just as many flaws or different usages as technical analysis. The second type of analysis is technical. Okay, technical analysis, and this is relatively new. Technical analysis, in fact, it continues to grow as the advent of high-speed internet technology comes on board. Some will refer to it as the wild, wild west of trading. As the years go by, there become a few more, set rules and different things like that, but it is ever changing. Okay, it is ever changing and it's very dynamic. Oftentimes, Charles Dow is credited with being one of the first to explore some of the aspects of technical analysis in the marketplace. And that was back early 1900s. Okay? The third type of analysis is basically your random walk. This is your dartboard theory. This is your idea that stock direction under any period of time, minute, monthly, daily, hourly, weekly, cannot be predicted. It's a random event, and this is a commonly accepted theory amongst academia. Within academic circles, the random walk theory is oftentimes talked about, proven in many ways, shapes, or forms there. And in trading, it can oftentimes seem like, hey, there is a random walk element. Okay. Obviously, I subscribe a little bit to the technical. I believe there's a fundamental aspect. But when I look at any type of analysis, we have to understand there's not a foolproof method out there. Okay, there's nothing out there that is going to be accurate 100% of the time, and it's about putting the odds in our favor. Okay, no matter which type of analysis that we are using. Okay, so let's break down technical analysis a little bit more here, and if we're going to use technical analysis, okay, we have to understand first what technical analysis is. And basically, technical analysis is the study, of price action in an attempt to discover patterns that are repeatable, okay, or repeatable patterns. That's really what technical analysis is trying to do. No matter what you're using in technical analysis, this is the attempt. You're trying to discover repeatable patterns, okay, repeatable patterns. Now, technical analysis makes three basic assumptions, okay? Number one, the first assumption is that the markets discount everything. Okay, markets discount everything. These three assumptions were originally made popular by Charles Dow, but as time goes on, people like John Murphy and other technicians have really come to adapt them. The second assumption is that prices move in trends. Okay, prices move in trends. And the third assumption is that history tends to repeat itself. Now, advocates of technical analysis say, okay, yeah, these are the assumptions, let's go forward. Okay, those who argue against technical analysis look at these assumptions and say, wait a minute, there's serious holes here. Okay, serious holes in these three assumptions that kind of negate technical analysis altogether. Okay, they say, well, the markets discount everything. Is that true? Do the markets discount everything? Okay, by discounting everything, we're basically saying that stock or whatever we're studying is a function of supply and demand. Okay, but proponents will look and say, well, we have something called asymmetrical information, okay, where not everybody in the market knows the same amount of information. And so the market can't really discount everything because certain groups know more than other groups. Yeah. Now, as high-speed internet technologies and the Twitters and the news feeds and all that, they continue to evolve, it can be argued that information is a little bit more symmetrical now than it has been in the past. But there still is insider information. There's still that aspect of some know, some don't, and so the market, it's very difficult to assume that it's discounting everything. The second aspect is that prices move in trends. Yep. Does that tend to happen? Sure. When we look at long-term charts and everything, you can see trends happening. Okay. One of the arguments against the fact that prices move in trends is that proponents will basically say, "Hey, prices pretty much adopt. Okay, they adopt all known information, and they price in the end result." So instead of a stock improving on its earnings and going from trending up from $10 to $20 over the course of 2 years, okay, we now see more activity in the market where news will come out of a stock and it will jump from 10 to 20, or it will make jumps to the final result. Okay, is this a great argument against technical analysis? I don't think so. I think this is a stretch to discredit technical analysis, but this is one of the arguments there. Now, the argument that history tends to repeat itself, this may be the most flawed argument in technical analysis. Okay, why would it be flawed? Well, yeah, can history repeat itself? Sure, but the markets are ever changing. Okay, so yeah, we could say, hey, this happened in 1980, this happened in 1970, and at some point the market will repeat itself, but do we know if it's repeating 1970, 1980, 1960 right now? No. Okay, we don't know when and where it's going to repeat itself, and the markets are very dynamic. They're ever changing, they're fluid. And so this third assumption, history tends to repeat itself, probably the weakest of the technical analysis assumptions, but these are the assumptions that are made. These are some of the flaws in those assumptions. So what can we take from this? Well, we can take from this that, hey, Technical analysis is not going to be a perfect science. Okay, probably never will be. There will be things that work and don't work from time to time. There are things that worked for a year that may not work for a 6 month period that may start to work again. Things can change, things can evolve, and be a little bit different. But that really is what makes the market and what gives us opportunity within the markets. Okay? Now, the basics of technical analysis here are uh, basically being able to use charts. Okay, being able to use charts, being able to analyze things on a chart, being able to see the price action that is happening out there in the marketplace. Okay, if you'll bear with me 1 second, it looks like for some reason my shockwave decided that it wanted to do a slight crash here. So let me just make sure that we're still up and functional here. May just need to go to a different browser. There we go. All right. So we basically have um, technical analysis, price action, and there are many different ways that we can go out and measure or plot the price action on a stock. Okay, one of the most popular in the market here today is with a candlestick chart. Okay, with a simple candlestick chart. Okay, one of the older or more popular forms of charting before some of the instant information was with things called point and figure charts. Okay, just a little bit different way to display information. Okay, we also have things like line charts. Okay, we could display the information with a simple solid line. Okay, shows price on one axis and time on another, and plots the price on with a line. We can do a bar chart. Okay, we can do several different types of bar charts actually exist. Okay, so there are several ways that we can go out and plot this information. And as technical analysis continues to evolve, there become more and more ways to plot the information. Different types of charting systems and ways to look at the price action in an attempt to find the best patterns that are out there. Okay. Now, if you'll bear with me, I'm just gonna see if I can log in here to my stock charts account. Make sure my email on here is correct. I'm not used to having to log in. Here we go. All right. So we could take a stock, let's say Boeing. All right. Since we're in Boeing, let's kind of talk about Boeing. And the most fundamental or basic concept when it comes to technical analysis is trend. Okay. So I'm going to come down. I'm going to get rid of all my other indicators. I'm going to get rid of everything. I'm going to get rid of volume. I'm just going to get rid of everything and just take this chart to a longer term chart. Let me make it a little bit bigger so it's easier for you to see. Okay. And let's just kind of zoom in on this here and take a look here at this chart of Boeing. This is just the price action, right? This one happens to be a candlestick chart. But what can we see? Well, we see that the overall stock has been kind of going up a little bit, right? What's been the trend? Well, there have been periods where the stock has gone down. There have been periods where the stock has gone up. There have been periods where the stock has gone up aggressively. Okay. The most common concept is this concept of trend. Now, there's no consensus view on how to measure a trend. Okay, there's no, hey, a trend is this, that, or the other. There are different ways that people will look at trend. Okay, perhaps the most common is simply with a trend line. Okay, a simple trend line. So we can take a look back here in early 2011 and say, Boeing was going up, and it seemed to kind of follow this upward line. So every time Boeing comes down to the lower line, we can look at it as an opportunity to buy. Okay? This type of trend, in order to be accurate, needs a couple things. Okay, the first thing that it needs are data points. Okay, and generally trend analysis, you need two data points to create a trend, a third data point to confirm a trend. Okay, what does that mean? Two data points to create a trend, three to confirm a trend. Well, if I put a dot right here and say, well, the price was at this level here at 100. Then I go put another dot up here. Okay, I can draw a line. I can draw a trend line, right? I can say we have a trend, but do we really? I mean, these are just two lines being connected. Is that really a trend? Okay. Well, if we have a third one, the odds of it being a trend are much greater. And saying, hey, we actually have a real trend going on here, not just two dots that, hey, we're just drawing a line. Okay? And this would be an upward trend, a series of higher lows. Okay? And in general, an upward trend, okay, I'm just going to write that out here on the chart. An upward trend is a series of higher lows and higher highs, while a downward trend is a series of lower lows and lower highs. Okay? And it's that basic. It's that simple. It's that, that concrete. Okay? Higher highs, higher lows, lower highs, lower lows. Okay? And we could just draw lines and create trend lines, and some of them you could argue are arbitrary, some of them may have validity. Okay? One of the other ways that people will draw trends is that they will use something called a moving average. Okay? And a moving average, if I come here to stock charts, I come down below to overlays. I come down here and put on a moving average, a simple. And let's just say 50 days. This may be the most common moving average. In our chart here, it's going to draw a 50-week moving average. Okay? But basically, the moving average just takes the price of the stock over, in this case, the last 50 weeks and averages it out and draws this line. Okay? And when our moving average is rising, the trend is positive. When our moving average is falling, the trend is negative. Okay? So what's the trend here on Boeing? Well, it's positive. Okay? I mean, we can break this down into a daily chart. Look at our 50-day moving average. What's the trend? Well, it's positive, right? And we have a positive trend going on. And we can use all sorts of different moving averages. One that I like is the 7-day moving average. It's a little bit closer. It follows the price action, in trend, a little bit of a shorter term trend. Okay, some like to go out and do a 200-day moving average. This is a much longer term trend, a much longer term picture of trend and what trend is. Okay? Now, one thing we have to keep in mind whenever we're looking at trend, or no matter how we're measuring trend, okay, is we have to take into account the time period. Okay, look here at this chart on Boeing. Now, Boeing has had overall an upward trend, right? But there have been periods of time, here in November through into early December, where the stock went from 140 down to 130, where it had a downward trend. Okay? There are times where it's had a flat trend or no trend. Okay? Depends on the time period we're looking at. If I go zoom Boeing in all the way to a 1-minute chart, okay, what's the trend? What's the trend? Not really any trend. It's going sideways, right? If I turn it into a 5-minute chart, the trend seems to recently be going up. If I turn it into a 15-minute chart, the trend will look a little bit different. And no matter what time period we use, we can see a different type of trend emerge. Okay? Generally speaking, the best way to trade the trend, okay? And you may have heard some of the market sayings, the trend is your friend, or never buck the trend, or there are a lot of sayings out there in the market to encourage traders to trade and constantly trade with the trend. Okay, well, how do you do that? What does that mean, trading with the trend? Are you trading with a weekly, a daily, a monthly, an hourly trend? Okay, what are you dealing with? Okay, well, the vibe and the vibe which we talk about quite often here at Trader Minute. Okay, the vibe essentially takes these measures of trend and takes the different time periods and overlaps them. Okay. The vibe looks at the long-term trend by looking at these major moving averages, the 50, the 100, the 200-day moving average. And if they're all moving higher and the 50 is above the 100 and that's above the 200, we have a positive long-term trend. Okay? So in the long term, our trend is for us. Okay, great. But riding a long-term trend, you can ride significant pullbacks. I mean, you can have significant drops in the stock even though the long-term trend is higher. Okay, so let's take a look at the midterm trend. Well, one of the popular indicators for midterm trend, and we'll break this indicator down a little bit more in the coming days, is the MACD. The MACD is a very nice midterm indicator, weekly, kind of 2-3 weeks. What's the trend? Really nice midterm trend measure. Okay. Then we have the 7-day moving average in here. And okay, 7 days, that's going to be a lot shorter term. Okay. So without having to go from a 15-minute to an hourly to a daily to a weekly to a monthly chart, we're able in one chart here to capture the long term, the midterm, and with the 7-day moving average, the short term trend of the stock. And the whole idea of the vibe is to play the trend. That is the whole idea. And it's using similar trend measures just in different time periods to kind of all confirm. And now if you have something moving on a upward short-term trend to the upside, midterm trend to the upside, and long-term trend to the upside, your probability of success is elevated. Vice versa, if we have a stock who's, well, let's go and see if we can find one here. Let's go with um, let's take BlackBerry here. Sorry, the ticker symbol just slipped my mind. BBRY. Okay, BBRY here. Okay. We take a look at this in terms of the same things that we looked at with Boeing, where we had all of our trends going up. Take a look at BlackBerry. The 200-day moving average is going down, the 100 is going down, the 50-day moving average is going down. So what's the long-term trend? Okay, the long-term trend is significantly lower. But does that mean that the stock's going to go down every day? No. Look over the last week. I mean, BlackBerry's gone from $6 up to 7.5. That's a sizable move, 25% jump in the stock price. Okay. Midterm trend with the MACD started to turn positive. Short-term trend started to turn positive. So we have kind of a trend mix here. We have long-term, midterm, and short-term trends looking different. When that happens, we could argue there's less predictability in regards to the stock. Okay, or the odds are not as much in our favor that the stock is going to go in the direction that we suspect based on all the trends being in the same direction. So trend is the most fundamentally basic concept when it comes to technical analysis. Okay. Now there are traders like myself who I love trading against the trend. It has not been a very successful thing to do in 2013. but a lot of times you get choppy markets. You don't always get a trending market that's just going up and small pullbacks and then going up, okay? But a lot of times you'll get very choppy markets where you can look at these trends and actually play trend reversals and look to trade against the trend. There are measures in technical analysis that go after that. So while, yes, the trend is the most basic and fundamental concept, as we go and look deeper into technical analysis, we'll be able to see how to use it to kind of trade against the trend, how to kind of understand, okay, when does the trend maybe exhausted, or when do the odds kind of go in the favor of some sort of trend reversal. Now, perhaps the second most basic concept when it comes to technical analysis, and maybe one of the more controversial concepts nowadays, is volume. Okay, and you can take a look at this chart here on Boeing. I'll zoom it in, but you look down here below. We have our volume bars. This just shows us how many shares of stock are traded on any given day. Okay? And the theory here is that volume precedes price. Okay? Volume precedes price, meaning we will tend to have an elevation in volume before a price move. Okay? Now, you don't have to look at a lot of charts to understand that there are a lot of holes in this idea, in this mentality. Okay? For several reasons. If we're dealing with a stock and we're strictly looking at volume, that's not telling us what's going on in the options market. Okay? I mean, people can play Boeing. I mean, like we're in Boeing right now. We're playing Boeing higher, and we don't own the stock. Our volume never shows up on here. Okay. So while yes, are we bullish on Boeing? Sure, our chart here isn't accounting for that through the volume. And as the options market grows bigger and bigger, we actually see that volume means less and less when it comes to technical analysis. Another problem with volume and looking at volume in regards to charts is the advent of ETFs. Okay, we don't have to go out and buy Boeing per se. Let's say we just want a piece of Boeing, so we go out and buy something like the diamonds. Okay, the DIA, the Dow 30. We're getting exposure to Boeing here without putting any volume on the Boeing chart. So volume here, is there a time, is there a place, is there a reason for it? Are there tendencies with it? Absolutely. Okay, absolutely. But take a look at something like Barnes Group here. Okay, look at this volume on Friday of last week. Okay, relative to normal volume, and you can say to yourself, well, volume precedes price, right? So we finally have big volume. That means the stock's going to go up, right? Well, not necessarily. Okay, we have big volume on options expiration. Okay, what's happening here? Well, a lot of these option contracts are expiring. So people are making changes to their stock holdings with Barnes Group. Some of them are using their contracts to buy into Barnes Group. Some of them are buying into Barnes Group because they have different contracts. There are all sorts of different reasons for this elevated volume that have nothing to do with price direction. Okay, Chevron. Okay, I mean Chevron's basically gone up with the market over the last couple days, right? But look at the huge volume, and Chevron went down on Friday. So if we kind of say, well, volume precedes price, we have a heavy surge in volume last Friday, and instead of Chevron going down, Chevron's actually going up. The heavy surge in volume had to do with options expiration, not necessarily with a change in price direction. Here's AT&T. Well, this went down Friday. Heavy volume. Options expiration, right? So volume doesn't mean nearly what it used to, okay? Doesn't mean nearly what it used to. In general, you're going to have heavier volumes come in on some sort of news. The Fed, okay? or earnings or something like that, it's an event. People aren't getting into this. It's not necessarily predicting the future direction. Okay, so while volume is an important concept and something to take into an account, this whole concept that volume precedes price is not near what it used to be 10, 15, even 20 years ago in the marketplace. In fact, a lot of times now you can look at heavy volumes and use that to actually spot reversals instead of trend moves. Okay? Now, with these concepts of trend, with these concepts of volume, okay, these kind of two very basic concepts of technical analysis, there comes a third, okay, and that is support and resistance. Okay? And I would argue that support and resistance is the most important concept when it comes to technical analysis. Okay, if you only ever trade with support and resistance, you can make money. You could do very well in the market. Okay, and the next tomorrow, our discussion on technical analysis will be entirely on support and resistance, and we'll dissect it in a bunch of different ways. But we have trend, we have volume, and we have support and resistance as your kind of three building blocks of technical analysis. Now, we have technical indicators, things like the MACD. I come down here, bring up a whole bunch of different technical indicators. There are software packages out there where you can create your own technical indicators. You can go out and have fun with, let's back test this or let's do that and break down the price action in any statistical way that you would like to try to find some sort of pattern. But really, that's what all of these are doing in one way, shape, or form. They are breaking down the price action in order to find a pattern that could be predictable and that could lead to understanding when to get into a trade and when to get out from a profitable standpoint. Okay, so as we go forward, next time we will talk support and resistance, and then as we go forward, we'll break down the various types of indicators, how they use them, and I'll show you some of the most popular ones out there, and I'll show you some of the ways that they are used and some of the patterns that are generally created with these various indicators. Okay. But understanding the principles behind the basis of technical analysis, will then allow us to understand the strengths and the limitations of things like trend and volume and support and resistance and technical indicators, and to understand that there is no predictive 100% crystal ball predictive capability in technical analysis. Okay. And as we go forward, we'll realize that technical analysis best usage is, yes, finding patterns, but then understanding where is our risk, where is our reward, and understanding what our tendency is or what the tendency with that individual stock is. From that point, we can then go out and make a decision as far as, do we want to enter or do we want to exit any particular trade. Okay, so tomorrow we'll jump in, we'll take a look at support and resistance. We'll break support and resistance down into 9 factors and take a look at it from that standpoint and go forward from there. Thanks for hopping on. You have any questions, please let us know, either via chat or shoot me an email off to jeff@traderminute.com. Happy to help you out, and we'll talk to you later. Take care.